Markets don't move on news. They move on expectations. Over the past few weeks, the headlines have looked increasingly positive. Economic data stabilizing, regulatory pressure easing, institutions quietly rebuilding infrastructure. And yet, markets barely respond. No breakout, no surge in risk appetite, no urgency. For many people, this feels counterintuitive. Good news is supposed to push prices higher, but that assumption is exactly where most market confusion begins. Markets don't reward good news. They reward changes in expectations. If something positive happens, but the market already expected it, prices don't need to move. In that case, the news isn't new information. It's confirmation, and confirmation rarely forces capital to reposition. A real move only happens when expectations are disrupted, either upward or downward. Most of the good news we're seeing right now doesn't disrupt anything. It fits the existing narrative. It doesn't rewrite it. Take regulation as an example. Recently, the Federal Reserve stepped back from guidance that had discouraged certain banks from engaging in crypto-related activities. Structurally, this matters. It reduces long-term uncertainty. It lowers tail risk. But markets barely reacted. Because regulatory easing isn't liquidity. It doesn't add money to the system. It simply removes friction. Normalization makes markets safer. Acceleration is what makes them move. And right now, we're seeing normalization, not acceleration. The same logic applies to institutions. When companies like Coinbase expand into stocks, prediction markets, or tokenized assets, they're not chasing short-term volume. They're preparing for relevance over the next decade. Markets understand this. This kind of infrastructure building signals durability, not urgency. It tells investors the system is maturing, not that capital needs to rush in today. So again, expectations stay anchored. Historically, markets don't react most to good news or bad news. They react to pressure points, forced selling, liquidity shocks, sudden changes in funding conditions. Think back to moments like Luna or FTX. Prices didn't bottom when headlines were the most dramatic. They bottomed when forced liquidation stopped. Markets don't panic over deterioration. They panic over collapse. And right now, what we're seeing is adjustment, not breakdown. That difference is everything. Another reason markets aren't moving aggressively is positioning. Risk exposure is cautious. Leverage is contained. Volatility remains compressed. There's no overcrowding, no desperation, no urgency to exit or to chase. When positioning is balanced, markets don't need to reprice violently. Silence, in this context, is information. This is why markets look quiet. Not because participants are confused, but because they're waiting to see if earnings roll over, waiting to see if liquidity tightens again, waiting to see if something actually changes the math. Until then, there's no reason to force a move. Sideways price action isn't indecision. It's patience. And patience is uncomfortable. It doesn't feel productive. It doesn't feel exciting. It often feels like nothing is happening. But in markets, nothing happening is often a signal that expectations are stable. And stable expectations rarely produce dramatic price action. And this waiting phase doesn't affect everyone the same way. For long-term investors, sideways markets are often periods of quiet accumulation. There's time to evaluate, not react. For short-term traders, however, patience feels uncomfortable. Low volatility means fewer opportunities, tighter ranges, and more false signals. And for institutions, this environment is ideal. They don't need price to move fast. They need stability to build positions without attracting attention. Sideways markets often favor the patient and the disciplined, not the aggressive. And this is exactly why so many people feel lost right now. Most market participants are trained to react, to respond to headlines, to associate movement with meaning. But quiet markets don't reward reaction. They reward understanding. When prices move fast, the signal is obvious. When prices don't move, the signal is subtle. And that's where most people struggle. Sideways markets create doubt. They make people question their framework. They make patients feel like indecision. But from a market perspective, this phase is often about absorption, not direction. Capital is repositioning quietly. Expectations are being tested, not broken. And until something forces that balance to snap, movement remains optional. So, what would actually break this patience? Not another optimistic headline, not another regulatory clarification. Markets usually move when something forces a repricing of risk. That could be a clear deterioration in earnings, a sudden tightening of liquidity, or a policy mistake that changes funding conditions overnight. Until something like that happens, markets don't need to rush. They observe, they wait, and they let time do the work. When you step back, this phase of the market starts to look very familiar. It's not a bull market. It's not a bear market. It's a transition, a period where excess is being absorbed, expectations are being tested, and capital is slowly repositioning. These phases don't feel dramatic in real time. They feel boring. They feel frustrating. But historically, they're often the foundation for the next meaningful move. Not because something exciting happens, but because the system quietly resets. So, if you're wondering why good news isn't pushing prices higher, this is why. Not because the news doesn't matter, but because it doesn't surprise anyone. Markets move when expectations are forced to change. If this helped you see the market more clearly, consider subscribing. I'll see you in the next one.